Hi friends, welcome back to the second part of our quick revision for Term 1 exam. Here I am C. Renu Srikanth Tantry. Today we will cover up two topics, namely the change in profit sharing ratio and admission of a partner. As you all already know that this exam is MCQ based question. So you will be facing questions like normal MCQs, case based MCQs and assertion reason type of questions. So let's start. First, we will solve some questions related to change in profit sharing ratio. So let us read the first question. First question is, identify the correct journal entry when the expenses on reconstitution of the firm is to be borne by the partner but paid by the firm. So now here we are supposed to pass a journal entry with expense on reconstitution of the firm. So when there is a reconstitution of firm, certain expenses might have to be required to be incurred. So basically that depends upon the internal agreement that who will be bearing the expense. And as per this particular context, it is to be borne by the partner. So responsibility of the expense or reconstitution is not of the firm but that of the partner. So he was supposed to bear it, but was paid by the firm. But who paid it? Firm paid it. And we are recording the transaction in the books of the firm. And when it is paying, obviously there is an outflow. So there is going to be an outflow. So bank balance is likely to get reduced, cash or bank balance. So here, when the cash or bank balance reduces, you know that we credit the cash or bank. So here, out of these four, if you see B and C, there is a credit of bank account here. But this was the responsibility, these expenses were responsibility of whom? The partner. So he is supposed to give back. How do we recover something from the partner? When something has to be given to the partner, we credit his capital account. And if something has to be recovered, we would have to debit the partner's capital. And as here it has been specifically given that the expenses on reconstitution is to be borne by the partner, then the amount is recoverable from the partner, and therefore we would debit the concerned partner's capital account and credit the bank account. So the right entry would be concerned partner's capital account debit. Whoever has been told that it is his responsibility to bear the expense, his capital account would be debited and bank account would be credited. So this is the correct entry. I hope it is clear. Now moving on to the next question, that is X, Y and Z are partners sharing profits and losses in the ratio of 1:2:3. Decided to share the future profits and losses equally. So there is a change in the profit sharing ratio from 1:2:3 to 1:1:1. They also decided to adjust the following accumulated profits, losses and reserves without affecting their book values by passing a single adjustment entry, which means they want these balances to continue in the books of accounts at the same value. They don't want it to be written off. Then they have asked us, they've given the detail, the general reserve was rupees 1 lakh, profit and loss account was a debit balance of 20,000 and advertisement suspense account had a balance of 20,000. They want the adjustment entry. What would be the adjustment entry? Now, here you need to understand that they do not want to affect the book values, which means they want the values to be there in the new balance sheet as well. So, what method, what steps will follow is as follows. First step would be we would calculate the net effect of all the reserves, accumulated profits, and losses. So, if you see here, the general reserve is 1 lakh. Profit and loss account, but note here, it is a debit balance, not a credit balance. So it is a negative amount. And advertisement suspense, where do you find advertisement suspense? We find it on the asset side of the balance sheet. It's a part of deferred revenue expenditure. So that is also a negative item. So the first step that we follow is to find out the net effect of all these amounts, which would be general reserve of 1 lakh, profit and loss account, it's a debit balance, so it would be a negative amount of 20,000, and advertisement suspense account, which is also debit balance because it appears on the asset side of the balance sheet. Therefore, the net effect here is 60,000. Once we've calculated this, then next we have to go to the next step. We have to calculate the sacrifice share or gain share of the partners. Now we will take what is a formula for calculating the sacrifice share. So the formula that we use is sacrificed, or if it is coming in brackets, it's gained share. The formula would be old profit sharing ratio minus new profit sharing ratio. So now we find the difference. Now I'll do the rough calculation here, and the three partners are X, Y and Z. So old profit sharing ratio is 1 is to 2 is to 3. So 1 by 6, 2 by 6, 3 by 6. Whereas the new profit sharing ratio is equally, which means 1 is to 1 is to 1, which means 1 by 3, 1 by 3, 1 by 3. Therefore, the sacrifice or the gain would be 1 by 6 minus 1 by 3, LCM 6, 1 minus 2 is minus 1 by 6. So, this is a gain. X is gaining as a result of change. Here it is 2 by 6 minus 1 by 3. 2 by 6, if you reduce to lowest form, it is same as 1 by 3. So 1 by 3 minus 1 by 3 is 0. It is neither gain nor sacrifice being made by Y. And the third for Z, you take 3 by 6 minus 1 by 3, 6. So 3 minus 2, 1 by 6. There is a sacrifice. So Z is a sacrificing partner and Y is the gaining partner. So this is what we arrive at. After doing this step, next you're supposed to calculate the share of gain or sacrifice. So in this 60,000, what is the sacrifice or gain? So the share of gain or sacrifice, how do we calculate? It is simple. Use the formula. You take the net effect that you have calculated in step 1, multiply it by the share gained or the share sacrificed, and therefore it will be equivalent to 60,000 net effect into 1 by 6. So 10,000 is the share of gain or sacrifice. Finally, you have to pass the journal entry. Now when we are passing the journal entry, it is simple. If it is a positive net effect, then the journal entry that we pass is we debit the gaining partner's capital or current account and we credit the sacrificing partner's capital or current account. Because the gaining partner is supposed to compensate the sacrificing partner. But if the net effect is negative, then under such circumstance, the reverse entry is passed. A sacrificing partner's capital account will be debited and gaining partner's capital account get credited. So from this, we see that in this example, the net effect is positive. So we pass the first entry. So gaining partner is X. So the entry would be X's capital account debit to the Z's capital account, an amount of 10,000. So this would be the journal entry that would be passed. So look at the here where X is being debited in A and in D, but Z has to be credited. So the solution is X to be debited, Z to be credited with 10,000. So this is a procedure that you have to follow, do the rough calculations and get the correct journal entry. And I hope this concept that where by passing a single adjustment, if say that is they without affecting the book value, just follow these 4 steps, do the rough calculation and get the journal entry. I hope that is clear. Now moving on, we will go to the case-based questions. So now here a case has been given and a few questions would be on that particular case. Let us look at that. Ajay and Vijay are partners, sharing profits and losses in the ratio of 2:1. From 1st April of 2021, they decided to change the profit sharing ratio to 3:2. This was the old profit sharing ratio. This is the new profit sharing ratio. And they also agreed on following. What have they agreed? One, goodwill of the firm to be valued at 60,000. Two, creditors not likely to be claimed amounted to 10,000. And three, land and building is overvalued by 10%. Now this is the case on this. The first question they have asked is Ajay's gain or sacrifice due to change in profit sharing ratio is. So we are just supposed to find out what is Ajay's gain or sacrifice. So what is the formula for calculating the sacrifice or gain? To calculate the sacrifice ratio, you just subtract old profit sharing ratio minus new profit sharing ratio. This is the formula that you have to use. If old profit sharing ratio minus new profit sharing ratio is negative, it means there is a gain. So now here we have to find out in relation to Ajay. So let us do the calculation. For Ajay, we have to take old profit sharing ratio minus new profit sharing ratio. What is old profit sharing ratio? 2:1 and Ajay is the first part. So it is 2/3. Whereas a new profit sharing ratio 3:2, which means 3 divided by 5. So LCM would come to 15. 3 5s are 15. So 2 into 5 would be 10. 5 3s are 15. So 3 into 3 is 9. So 1/15. This is a sacrifice. So from this, what do we understand? That Ajay is sacrificing 1/15. So D option is the right answer. So remember, sacrificing ratio is old profit sharing ratio minus new profit sharing ratio. And if it turns out to be negative, it is a gain. I hope this concept of sacrificing ratio is clear. Now let us go to the next question related to the same case. The next question is, who will give goodwill to whom and how much? So we have to see who has sacrificed, who has gained. From the previous working, you have seen that Ajay has sacrificed 1/50 and there are two partners. So obviously from this we ascertain first step we have to calculate the sacrifice or gain share, and through the first step we know that Ajay has sacrificed 1/50. This implies Vijay has gained 1/50. Now, after that, calculate the amount to be compensated. Now we have to find out who is to compensate. Now the person who is sacrificing has to be compensated. So Ajay is sacrificing, he has to be compensated. Now when Ajay is sacrificing, he has to be compensated. Who is gaining? Vijay is the gaining part. So Vijay has to compensate Ajay. That is clear now. So Vijay will give Ajay. Now, beyond that, we have to calculate the amount to be compensated. Now, how do we calculate the amount to be compensated? Now, we have to see what is the amount of goodwill. If you look at the question, they have said goodwill of the firm is valued at 60,000. So, that is the value of goodwill of the firm. Therefore, amount to be compensated would be goodwill of the firm into the share gained or sacrificed. This is the formula. So if you look at that, 60,000 is a goodwill of the firm into 1/15. So rupees 4,000 will have to be compensated. Therefore, here as we have seen, Ajay is a sacrificing partner and Vijay is a gaining partner. So Vijay has to give Ajay how much? Rupees 4,000. So if you look here, Vijay has to give Ajay 4,000. So it is D, which is the correct option. So I hope you have understood who has to compensate whom. The gaining partner has to compensate the sacrificing partner. How much is to be compensated? Take the goodwill of the firm, multiply it by the share sacrificed or gain to get the exact amount of compensation which has to go from the gaining partner to the sacrificing partner. And for all this, first you have to find out who has gained and who has sacrificed. For that, I've already discussed the formula here. That old profit sharing ratio minus new profit sharing ratio will give you the sacrificed share. So let us move on to the next question. Third question we have is, which account will be opened to transfer the amount of creditors to be written off and to which side of the account? Now, they have given in the question, if you observe, they have given the second adjustment which says that creditors not likely to be claimed amounted to 10,000. What does this exactly mean? It means that you have creditors of 10,000 but they are not likely to be claimed. It means they are not going to come back and ask you for the money, which means a liability which you have in the books is maybe no longer payable. So that has to be adjusted in the books. So when there is a liability which you no longer have to pay, what does that mean? It means that you don't have to pay, it's a gain for you. So when such a thing is there, first of all, you analyze that it is a gain to the firm. Now, what are we doing? There is a change in the profit sharing ratio. So, which account will be used? If you look at the option, there is realization account debit side, realization account credit side, revaluation account debit side, revaluation account credit side. Now, whether we are going to use realization account or revaluation account, when there is a change in the profit sharing ratio or there is admission of a partner, we use revaluation account. We revalue the assets and liabilities to their current figures. Realization account is when we are closing down the firm. In case of dissolution of the firm, when we are going to dispose of the assets and pay off the liabilities, we use realization account. So from that, immediately these two options are cut out. We have these two. Revaluation on debit side, revaluation credit side. Now important. Revaluation account, when it is opened, on the debit side of the revaluation account, we write all the items which are in the nature of losses. So on the debit side, we write items which are the nature of losses, and all types of gains would be credited to revaluation. Now here, creditor being a liability no longer payable, it's been written off, which means we don't have to pay a liability, which is a gain to the firm, and therefore it would come on the credit side of the revaluation account. So the correct option for this answer is revaluation account side. So with this, you have understood that we prepare revaluation account in case of the change in profit sharing ratio in respect of revaluing the assets and liabilities, and all the losses type items would be debited to revaluation and all sorts of gains would be credited to the revaluation. I hope that is clear. Now with that, I come to the end of the change in profit sharing ratio. Now we will do some questions and understand certain concepts related to admission of a partner. So let us take up the first question, admission of partner. First one is X, Y and Z are partners in a firm. If P is admitted as a new partner, then what happens? A, old firm is dissolved. B, old firm and old partnership is dissolved. C, old partnership is reconstituted. D, none of the above. Now, when there is the admission of a partner, you should understand whether it's reconstitution of partnership or reconstitution of firm. It is reconstitution of partnership. The internal agreement between the partners is going to undergo a change. A new partner P is coming into the business, and therefore the internal agreement is going to change and he has to be given a share out of the existing partnership. That is what is going to happen. Internal modifications are going to take place in the partnership agreement. So it is not reconstitution of the firm, and therefore there is no dissolution of the firm or there is no dissolution of old partnership. But the correct option here would be the old partnership is reconstituted, new partners admitted, and the agreement in between them undergoes a change to accommodate the new partner as well into the business. So I hope that concept about admission of partners is clear to you. Now moving on to the next question. A, B and C are partners sharing profits and losses in the ratio of 10:6:5. They admit D into partnership and decide that profit sharing ratio between C and D, the new partner, and the existing partner C shall be same as existing in between A and B. So what is the relationship between A and B, the profit sharing ratio? It is 10:6. So if you take between A and B, it is 10:6. They want after admission of D, in between C and D, it should be the same ratio of 10:6. So for that purpose, what we will do is we have to find out what is the relationship between A and B. We can say from this, we can say that B is having 60% of 10. That would make it to 6. So B is having 60% of A's share. Okay. So same should exist between C and D. But we know C has 5. So C has 5. What is 60% of 5? That comes to 3. Okay. Therefore, the relationship between C and D, so that it is same as between A and B, would require that D should be admitted for 3. Therefore, if you take the ratio between A, B, C and D, A has 10:6 and C was having 5, D will have 3. When D has 3, then 3 is 60% of 5. And if you see, if you reduce this 10:6, it is also reduced to 5:2. So therefore, you have been able to maintain that ratio between C and D is same as that was in between A and B. So this is how we go about finding out. And then if you see the option, your option C is the right answer. So I hope that is clear. What do we do? The first step we did was between A and B, what was the ratio we found out? We found out that B was 60% of A. And then we applied the same ratio because we had that of C here. So we could find out for D 60% of 5 is 3. We just to replace it there. So the ultimate ratio comes to 10:6:5:3. So hope that is clear. This type of questions can come to you in the exam. Now finally we'll go to case-based questions. Now here in this question, let us look at this. Amit, Sumit are partners sharing profits and losses in the ratio of 3:2. Their fixed capitals introduced were 1,20,000 and 80,000. So note it is fixed capitals. As you're reading, note down all these aspects. At the end of the first year, they had a net profit of 1,20,000. It was before allowing remuneration. So it is before allowing this remuneration of 3,000 per quarter to Amit, 2,000 per half year to Sumit. So everything is different. It's quarterly, this is half year. Expanding the business next year after 6 months into the accounting year. So they decided that they'll expand the business, and by the time they decided, it was already 6 months into the accounting year. They decided to admit Namit. Namit is a new partner being admitted for 1/5 share, that is 20% in partnership. With a monthly remuneration of 2,500 per month, Namit has been admitted for monthly remuneration. He introduced capital of 1,30,000 and 70,000 as a share of goodwill. He also gave a loan of 1 lakh to the firm for 2 years. So this is the case that we are encountered with. Now, let us look at the first question. First, remuneration to partner shall be transferred to. Now, where do we put the remuneration to partners? In the appropriation account, the net profit is appropriated and given in different manners in the form of interest on capital, commission, remuneration in different form like salaries, and so on. So here in this example, we have remuneration to partners. Where do we put it? Whether to the capital account, loan account, current account, or none of them. So when something is to be given to the partner, we normally put it to the capital or current account. So we will not put it into loan account. It is not a loan being given. So it will be either A or B. Now look at this situation. They are following fixed capital system. You should know that there are two different capital systems which can be followed by partnership. fixed capital system and fluctuating capital system. So under fixed capital system, we have two accounts being maintained. One is the capital account, other one is the current account. The other method is the fluctuating capital system. So in this capital system, only one account is maintained for each partner, that is capital account, and all the transaction goes through this capital. So when fixed capital is maintained, only the capital related addition and permanent withdrawals go there, whereas all items of appropriation go through the current. And in this given situation, if you see, they are maintaining fixed capital system and therefore the items of appropriation goes into current account, and therefore the remuneration to partners shall be transferred to current account would be the right answer. So I hope now this concept of fixed and fluctuating capital system is clear to you. Always refer to the question carefully to see which method they are following. If nothing is specified, you can take it as fluctuating capital. But when it is said fixed capital, then you know that they maintain current account. So now let us move on to the next question related to the same case. On admission of Namit, the sacrifice of profit share is by. Who is sacrificing? They're asking. Basically, you have to calculate the sacrificing ratio. Now here, important. Who is sacrificing? Amit only, Sumit only, Amit and Sumit equally, Amit and Sumit in 3:2 ratio. So now don't go directly jump into calculating the sacrificing ratio. Look at the option. They have not given it in the form of fractions. 1 by 5, 2 by 5, nothing has been given. So don't jump to calculation. They're asking who is sacrificing, who is gaining. So for that purpose, what are we supposed to do? We know that sacrifice, whatever we calculate sacrificing ratio, it is old profit share minus new profit share. So let us look at the question. They have said the old partners Amit and Sumit were sharing profits and losses in the ratio of 3:2. And they have also said Namit is introduced into partnership for 1/5 share, that is 20% in the partnership. Have seen in the entire question anywhere, have they specified how this is being received by Namit from Amit and Sumit? They have not specified how Amit or Sumit is sacrificing, how much they are sacrificing, or how Namit is acquiring from Amit and Sumit. So there is no specific ratio. It is not specified that Amit is only sacrificing, Sumit is only sacrificing, or they are sacrificing equally. Nothing is there. So when you encounter such question, the important point you have to remember is when nothing is specified and only that they have specified that new partner is admitted for a particular fraction of share, then we assume. What do we assume? We assume that the old partners sacrifice in their old profit sharing ratio. So there is an assumption being made. We assume old partners sacrifice in their old profit sharing ratio. So remember this, and therefore old profit sharing ratio between Amit and Sumit was 3:2. Amit and Sumit. So here on admission of Amit, the sacrifice of profit share is by both Amit and Sumit, and it is in the ratio of the old profit sharing ratio. Therefore, the correct option here is D. I hope that is clear. Moving on. The third question we have related to this case is Namit will be entitled to remuneration of. Now, what is the remuneration he is entitled to? Let us look at the question again. Here, they have said Namit is admitted for 1/5 share in partnership with a monthly remuneration of 2,500 per month. Now, per month means immediately you jump and it's a 2,500 to 12. That is the remuneration. Read carefully. When was he admitted? Was he admitted at the beginning of the year, accounting year? Then it would be 12 months. Here, if you see, expanding the business next year, after 6 months into the accounting year, they've already entered the accounting year and 6 months has passed off. So after that, he was admitted. So after 6 months completed is admitted means he is been partner for only 6 months in that year. And therefore, he'll be entitled to monthly remuneration of 2,500 per month for 6 months. So 2,500 into 6. That would be 15,000 rupees. So the correct option would be 15,000. Here what you should have observed was when was he admitted. That is important. The admission was per month, but he was there only for 6 months in that accounting year, and therefore is entitled to for remuneration for only those 6 months. I hope that is clear to you. Now let us move on. There's one more last question related to the case. With respect to loan advanced by Namit to the firm, he is entitled to interest. Now, if you look at the question, they have said he also gave a loan of 1 lakh to the firm for 2 years. So he has given loan in addition to his capital to the firm. Now, in respect of a loan being given by a partner to the firm, you should note that in case of there's a partnership deed and there is an agreement as to interest to be given to the partner for the loan he has given to the firm, then that interest would appear. But however, when they gave all the detail in the case, they have not specified anything that is entitled to so much interest, which means in the partnership deed, the interest is not available. When no interest has been specified, in the absence of deed or in the absence of rate on the loan given by partner being specified in the deed, then under such circumstance, we have to refer the Indian Partnership Act. So when we refer to Indian Partnership Act of 1932, the provision says that interest on partner's loan has to be provided at the rate of 6% per annum. So minimum 6% has to be given to the partner when he advances loan. Therefore, the correct option here is B, 6%. So this is the option you are supposed to select. I hope this concept is clear. So this is how you have to solve the case-based questions. Now let us move on. Let us do some assertion and reasoning questions for your understanding. The first question we have is, in the following questions, a statement of assertion is followed by a statement of reason. Mark the correct option as, in case both assertion and reason are correct and reason is a correct reason of the assertion, then you have to mark A. If both assertion and reason are correct but reason is not the correct reason of assertion, then you mark it as B. Only reason is correct, mark C. And if both assertion and reason are wrong, you mark D. So look at this, read this, what they have given, and accordingly you mark. Their wording might be a little different in the exam. It can be correct explanation, or they can give other options also. Now let us look at the first question that we have in hand. Assertion is Ram and Rahim share profits in the ratio of 2:3. They decide to change the profit sharing ratio and share the profits equally. Ram is the gaining partner. Here they have said they are sharing 2:3. So Ram and Rahim. 2 by 5 and 3 by 5. They decide to change it equally, means half and half. So from this, if you calculate 5 2s are, so 4 minus 5 minus 1 by 10, which is a gain here. And here if you take is 2, 6 minus 5, 1 by 10 sacrifice. So from this we see that Ram is the gaining partner. So Ram is a gaining partner. So this assertion is correct. Now let us look at the reason. Ratio of Ram is 1 by 10. Is ratio of Ram 1 by 10? No, right? The gaining ratio of Ram is not. Gaining ratio is 1 by 10. Ratio of Ram is not 1 by 10. Ram, therefore, the reason given here is wrong. The reason as a correct explanation should have been Ram is the gaining partner as the share of profit increases from 2 by 5 to 1 by 2. That would be a correct reason. This reason is not a correct explanation of this assertion, and therefore both are correct individually. 1 by 10 is correct, but gaining ratio. But it's not a correct explanation of your assertion, and therefore B would be the correct option. So option that you have to mark is B, where both are correct by individually, but reason is not correct reason of assertion. Hope that is clear. Now we go to the next question. The assertion here is profit or loss on revaluation of assets and reassessment of liabilities is transferred to the all partners capital or current account in all profit sharing ratio. Yes, true. When there is a change in profit sharing ratio or admission of partner and we go about changing the value of the assets and liabilities, we open a revaluation account and we put all the adjustment through that, find out the net profit or loss on revaluation. If there is a profit, we transfer it off. Whether it's a loss or profit, we transfer off to the partner's capital current account and it will be given in the all profit sharing ratio. Because that was earned in case of change in profit sharing ratio at the time before they changed their profit sharing ratio. And in case of admission of partner, that revaluation belongs to all partners and therefore has to be given to the all partners in all profit sharing ratio. So here the assertion we have is correct. Now let us look at the reason. All the accumulated profits and losses and reserves are transferred to the old partner's capital or current account and all profit sharing. Here we are talking about just revaluation of assets and reassessment of liabilities. But here we are talking about accumulated profits and losses and reserves. Now here if you see in itself it is correct that we do transfer the accumulated profits, losses and reserves to old partner's capital account. But this reason is not a correct explanation of the assertion here. And therefore here what is the option that we are supposed to select? The correct option would be again B, because both A and R, that is the assertion is also independently correct, reason is also independently correct, but the reason is not the correct explanation of the assertion which has been made. So therefore option B would be the correct answer here. So friends, with this, I think you must have got clarity on many of the topics coming up for your exam. If you like the video, then do like it and leave your valuable comments in the comment section below. Do share this with your friends who are also attempting the Term 1 examination in the month of December. So see you soon. Stay tuned. I'll be back with the third session soon. If you have not yet subscribed, then please do subscribe and click on the bell icon to get notifications of my videos. Thank you. Have a great